Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. I'm the host, Richard Benuli. Today is December 6th in the Western Hemisphere and December 7th in the Eastern Hemisphere, where Tom is located in Singapore. He's a returning guest, and he has over 2 decades of experience in the realm of economics and finance, expertise ranging from covering the global economy, deciphering financial markets, macro forecasting, and advising on investment strategy. He actually started his career in New York City at the outset with a large money center bank and then at a hedge fund. And then in Singapore, he's worked at 2 financial institutions and later joined academia. He's been consistently ranked among the top 5 most accurate economists in the world on forecasting the U.S. economy overall. And he was exclusively identified by Bloomberg to have accurately predicted the onset of the 2009 U.S. recovery 16 months ahead of time of the official announcement. And so consequently, he's been widely publicized as one of Wall Street's most prophetic economists. Welcome, Tom.
Thanks, Richard. Pleasure to be back.
Great. Yeah, I thought we'd begin with your thoughts on the macro backdrop, your global macro view on the economy and the financial markets. You were mentioning just before we started about the market repricing front and center since our last discussion. Can you elaborate?
Yeah, sure. Well, I think just to set the backdrop and just look at how things have transitioned. I think one way to frame this really is to look at it from 3 angles. First of all, there's this expectations gap that's ongoing. The apparent disconnect between markets, what markets are expecting central banks should do, and what central banks or policymakers are trying to manage or trying to shape expectations at this juncture. So that's the first. The second apparent risk here is elections and geopolitics. I think next year we are going to a number of elections in the larger economies at least, and that might also shape market expectations, policy, the economy, and so on. And then finally, the fundamentals gap. I mean, ultimately, inflation has been improving, but in order for it to improve further, you need aggregate demand, so to speak, to moderate, right? Because otherwise, you would need improvements in aggregate supply, in order for inflation to improve. So in this backdrop, when you have more restraints on demand, you would think that the next risk is that how close are we to a downturn or to a recession? So I think those are the 3 risks as we get into how things will likely shape over the next 1 year or so.
Mm-hmm. Interesting. And in terms of on the repricing, which areas do you refer to? How do you see that playing out?
Yeah, I think the most immediate, obviously next week we have the FOMC, the last FOMC for the year as we shape into prepare for next year. I think that it's obvious that the market expectations and everyone's on board that the Fed is going to remain on hold. The question here is, what's going to transpire on the forecast, the projections. I guess on the one side of it, I think that there is very good chance the Fed is going to revise the growth forecast for For GDP, I think they're probably going to bump it up, for this year, and then depending on what it is for next year. And then the inflation side, I think they're going to revise it down for this year, and then that depending on where we end this year, they might revise it, tweak it a bit for next year. So given that backdrop, I guess the next natural question is the dot plot, right? And this is where I think, as I mentioned earlier about the disconnect, the Fed has 2 rate cuts next year, conditional forecast based on the dot plot. I think the market at this time has more than 4 rate cuts, more or less priced in to a certain extent. I mean, obviously things are still evolving. And I think I mentioned in our prior podcast that my sense is still that I think the most likely window for the Fed to cut interest rates is probably June through September, in that time period of next year. I still think it's pretty reasonable, that forecast, and that incidentally was ahead of the pack. I think that having said that, it's clear that the Fed needs to be very delicate. I think they need to tiptoe as you get into next year because of the election, U.S. elections next year. And I think that, one way to think about this is, I mean, everything is interlinked in a way. I think, there's no reason for the Fed to try to push things too hard if they are somewhat unsure, especially ahead of the elections. And I think the research tends to show that when the economy is not doing well, when the markets floundering, there's a tendency for the incumbent not to be reelected, right? Or the incumbent party not to be reelected. And that's a risk, I think, that the Americans, or at least some parts, at least in some parts of the American, public, that there's a real risk there. So I think that they have to tiptoe, in other words. And in fact, this is probably a good way to shift the discussion somewhat. I mean, next year and 2025, the next 2 years at least, I think cumulatively, I think 75% of the larger economies, call it the G20 or G16 to be more accurate, given that there are elections, for 75% of the G16. And one way to really pin it down is that if you look at U.S. election cycles, I think that a simple way to think about this is that usually, and this is just the usual mix of things, just looking at data and nothing else equal, you usually get a stronger dollar as you get into the year of the election. Maybe a stronger equity market, slightly higher equity market as you get into the year of the elections, and for the US, that is, not globally. And I think that if you look at the data, if you dig deeper into the data, you can see that there is a tendency to lean more toward the US markets more positively than the rest of the world. Global ex-US equity markets tend to be softer, but there's a tendency for that during the election year in the US. Interest rates, they tend to be a bit more diverse, the reactions during the election year. On a median, tend to be more flattish, but the bias is that there's an easing bias as you go into the election year. Not necessarily the Fed is going to ease, but there's an easing bias. If the Fed were to choose to ease during the election year, the magnitude of easing tends to be larger than the magnitude of rate hikes, on average in prior election cycles. And then as far as commodities, I think given the stronger dollar, the tendency for election year, I think that commodities, I think probably especially precious metals tend to be a bit weaker. But again, there are diverse drivers for commodity markets, as you know, Richard. So so the outcomes tend to be quite spread out. So that's one way to think about that as far as markets linking back to the economy and linking back into the Fed. And I just want to overlay that further, by thinking that, as I mentioned earlier, one of the risks is that if you think that that the moderation in inflation is the most likely outcome as you get into next year and the year beyond, then in order for that to happen, demand has to somehow soften in that scenario. And when demand is softer, the next question is really, what is the likelihood of recession, right? Because as you get closer to the, I guess, the threshold for whether it's positive or negative growth, in general. And I think that, it's not easy to forecast recessions, especially as you get, beyond 6 months. But I think if you try to zero in on the more contemporary odds of recession, which I look at, I use my weekly recession odds. I track it on a weekly basis. I think the odds are close to a coin flip at this juncture for a U.S. recession, and that includes financial variables and also economic variables. A good mix of that. But if you take out the financial aspect of it, just looking at economic variables, it's decidedly less than 50% still. So like I said, so I think the Fed is in a way trying to manage that, making sure that they want inflation to come back to their comfort zone, but at the same time, they need the growth backdrop to weaken in order to coincide with the improvement in inflation, right? Otherwise, you would have to make an assumption that some supply, broad supply improvements to help inflation. So that's where the dichotomy or the challenges.
Yeah, that's very interesting observations on that for the U.S. What are your thoughts on Europe? Do you see them with similar challenges or different? And in particular, the euro currency and interest rates there in Europe, like what's going on there?
Yeah, well, Europe is in a very similar position, except that they are one layer down the scale. In other words, they are a much more challenging spot, although very similar challenges to the rest of the bigger economies. And I think that on the immediate basis, I think the growth backdrop in Europe, there is downside risk. I mean, we had a negative quarter, in the third quarter. So there's a good chance that we could see another, close to zero, if not negative, quarter. Mm-hmm. And as a result, the full year is probably around 0.5% or so for this year. Next year, I don't see it to be any better. I think probably less than what it is this year. And that is at odds with the ECB, projections. So there is room for the ECB to shave off, at least several tenths from the forecast. But I guess the next question is, given that scenario, why isn't the ECB more aggressive in talking up the chances of rate cut? Well, precisely because most of the developed world, inflation is above their goal, right? Although there is a bit more flexibility given the change in the ECB mandate, a bit more flexibility in the single mandate under Lagarde. But I think that even though the recent inflation numbers from the euro area have come in more positively, in other words, there are more improvements directionally Core, headline inflation, as you know, is around 2.5%, 2.4%. And then core inflation, closer to 3.5%. But I think another way to look at this, and I think this is perhaps another way to consider the inflation risk, is to look at the most persistent categories of inflation and the least persistent categories of inflation, rather than just slicing it based on core and headline and so on, right? And I think that the most persistent category of inflation, HICP inflation in this case, I think it's probably slightly less than 4%. That is still roughly, with double thereabouts the ECB's goal. So as a result, I don't think they are, that comfortable with playing up the possibility of rate cuts despite the weaker growth backdrop. The least persistent category of inflation in the euro area, I think it's negative, probably around maybe around the -2 or thereabouts, perhaps. So I think you have to be a bit more careful. I think and typically the ECB cycles tend to follow the Fed to a certain extent, although there is some deviations from time to time. So I think that given what I've talked about earlier about the most likely window is for the Fed to do something, in terms of turning more accommodative, between June and September, I think the ECB might lag a bit. So maybe toward the tail end of that, window, or maybe a bit later, depending on how the inflation backdrop evolves. But having said that, I think that the other aspect of it is the geopolitical aspect, right, in Europe, given how the proximity to Russia and whatnot. As a result, household saving propensity in Europe has gone up a lot. It's like above 2 standard deviations above the mean. So I think the reluctance to use saving to boost demand, and most of the excess savings in Europe have been parked, in either paying down debt or into financial assets, tied down, and so it's unclear whether they're going to dig into that in order to cushion any downside risk on the growth front. But certainly, I think that, as I said, directionally, I think the euro area is moving more or less in the direction of the US, but weaker growth. And although the inflation seems to be lower, but depending how you slice it, maybe it's still above the policymakers' comfort zone. And on top of that, you have to take into account the geopolitical risks. And incidentally, they also have European parliamentary elections upcoming. So that's also another thing they will take into account. And I think I just want to slip something in. Aside from all this, I think one of the so-called risk factors, as far as beyond the fundamentals aspect, is the COVID. I think it's, if you look at some of the numbers in the UK, the labor market inactivity, right, long-term sickness, if you look at that figure, it's about more than 7% of the labor force. That's huge. It's about like around 30% above trend, as far as long-term sickness in the UK. And that's a very noticeable number. There is some disparity. If you cut it deeper, the females tend to be more susceptible than males in the long-term sickness category. But if this continues, like I said, directionally, it's 30% above trend, a bit higher for the females relative to the males. But this is going to impact longer-term growth in the UK. In the UK, growth outlook is definitely weaker than what I discussed, and inflation also appears to be higher. And as a result, the Bank of England is also very likely to be, even more lagging relative to the ECB, perhaps. Yeah.
And your thoughts on the currencies? Any ideas for short, medium-term trends in the euro and the pound?
Yeah, I mean, I think, broadly speaking, I think that over time, there is always room for diversification away from the US dollar. I mean, given the deficits, and given how there is a lot of discussion surrounding the political aspects of the US, depending on how the congressional elections turn out and so on. There is a lot of dysfunction. But on the other hand, there is also demand. I mean, typically when the world is more uncertain, the US dollar tends to be stronger, in all else equal. So I certainly don't see the euro or the pound, taking any more, significant share from the US dollar, as far as from that aspect. But at least as you get into the election year, as I say, the US dollar, the propensity for the US dollar to be stronger tends to be higher. So as a result, I would probably lean more toward that. And I think, like I say, you play into the fact that there is still the geopolitical aspect in the whole debate. I certainly think that there is room for the dollar to strengthen, reverse some of the weakness that you have seen because of the central bank or the Fed the change in Fed the abrupt changes in Fed expectations of late.
Great insights and observations. Any final thoughts overall, and also how can our listeners and viewers learn more about your work?
Yeah, well, I certainly, I write stuff, I do podcasts with you, Richard. So I guess, and I'm open to any discussions or anything of that sort. But certainly, I'm an independent economist, so feel free to reach out if there's anything. But other than that, coming back to the macro side, I think that one of the key things to keep in mind that clearly there are a number of moving parts, and some of these moving parts are going to be tied in not only to the fundamentals, not only to the policy side, but also the non-policy, which I talked about, the elections, the geopolitics and whatnot. So I think that to figure into how things are going to evolve, I think you need to really wear different hats. And one final thing, aside from just looking at the near term, clearly one of the things that people tend to ask is that how equity prices, let's say the US equity market's going to perform, say over the next decade or so. If you look at over the last decade through 2021, US equities had a great run. Real return was more than 10%. Obviously 2022, notwithstanding, was a tough year. 2023, this year, starting to claw back some of that. So the next decade, I suspect it's going to be tougher, weaker than the last decade through 2021, right? I think the range, we could see perhaps even negative real return in US equities. But I think the range is maybe slightly less than what we got over the last decade through 2021. But certainly the tendency is for real returns to be weaker. So tougher for everyone, including you and me.
Yeah, exactly. And we'll continue to wear those different hats to help us understand the macro backdrop in the economy and the financial markets. Well, great. Thank you so much, Tom, for these discussions and thoughts. Thank you.
Thanks, Richard. Pleasure being here.
Yep.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.